The market's coming off a volatile week that has left investors anxious about what comes next. Joining us right now is Lori Calvasina, RBC Capital Markets head of U.S. equity strategy. And Lori, last week was a bit rocky. This morning, we're looking at the futures down pretty significantly, too. How are you feeling about things?
So, look, we haven't changed our target. We've been talking about sort of our base case and our bear case all year, and we've said the risks of our bear case have risen. And sort of embedded in the idea of our base case was a 5 to 10% drawdown. So we thought the market would end the year at 6,600, but have a 5 to 10% drawback during the course of the year that it would bounce back from. I do think the risks now are rising that we get something worse than a 10% drawdown, something, say, in the 14 to 20% range. We haven't pivoted to that. But I do think it's an important distinction because you're starting to see, other houses, frankly, start talking about the risks of a recession are rising. And I think it's important to remember in equity markets, sometimes we have something in between just garden variety pullback and recession pricing. A recession is worth about a quarter to a third of a drawdown in the market. From GFC to COVID, we had a
great financial crisis.
The financial crisis. We had a number of these 15 to 20% drawdowns, which were growth scares. So fears of a systemic issue, the U.S. debt downgrade, sovereign debt crisis, the 15-16, kind of mini recession hit the industrial sector, not the consumer, and then sort of the debacle of 2018. And so I'm worried about that kind of scenario manifesting in markets. Not there yet, but that's where my radar's up.
But you still think it's temporary. This would be a sell-off that would be a buying opportunity.
I think that valuations, and we wrote about this in our weekly today, are starting to get interesting. If you look at the small caps, I'm an old small cap strategist, so they're always a good barometer when things get a little nutty in the market. And we're at 14.5 times. We've broken below average. 2015 through 2019, average tended to be the bottom. Recessions are about 11 to 13, so you're actually not that far off from recession pricing in small caps. The broader markets have got a little bit more work to do. S&P X top 10 is trading around 17 times. The average is more like 15, so we need to break a bit more than that. But things are starting to I wouldn't say problems are getting fixed, but froth has come out of AAII on the retail investor survey. We're getting some froth out of these valuation metrics. Even the top 10 market cap names in the S&P are trading around 14 times or 24 times. That's down from 30.
I mean, that's an investor's point of view. Does that make you actually happy to see something like this? If things start to get a little more reasonable, start to come down in price, it's a buying opportunity. OK, so.
Well, certainly I would say.
But you don't worry about the bigger issues that would mean that we're down for the year?
Look, I think that stocks do tend to go down, and we've had a number of, up years and some fantastic up years. And if we hit my bear case, which would be about 57.75, we'd be down a few percent. And that is typically what happens when we get down years in the equity market. The big major crises tend to be very, very rare. You never want to see stocks go down, especially when it represents economic angst, right? There are real people out there that get affected by that. But I do think we just came into the year very frothy on the CFTC data, extremely frothy on valuations. I think we were going to have a bit of a pullback, 5 to 10% again, one way or the other. Again, risks of going beyond that are rising, but I do think we needed to get some of this froth out.